If you had $100,000, would you put all of it into one single stock? Just one? No backup plan, no safety net, just all your eggs in that one basket? If that idea makes you feel a little uneasy, you're already halfway to understanding why diversification matters. Because when it comes to investing, it's not just about chasing gains. It's also about protecting what you've worked so hard to earn. So if you've ever heard the term diversify your portfolio and thought, okay, but how do I actually do that? You're in the right place. Diversification sounds complicated, like some secret strategy only rich people or Wall Street pros really understand. But here's the truth. It's actually a simple and powerful way to reduce risk and build long-term wealth. In this video, we're going to break down what diversification actually means. No jargon, I promise. Why it's one of the smartest things you can do as an investor, and how to diversify your portfolio, even if you're just starting with a few $100s. By the end, you'll know how to protect yourself from major losses, grow your wealth steadily, and invest with a whole lot more confidence. Let's get into it. What is diversification? Let's keep it simple. Diversification means not putting all your money in one place. That could mean spreading your investments across different asset types like stocks, bonds, and real estate industries like tech, healthcare, or energy geographies like U.S. markets, international markets, or emerging economies, company sizes like large cap, mid cap, and small cap stocks. The basic idea? If one area takes a hit, the others help soften the blow. Imagine a farmer who plants only oranges. If there's a bad season for oranges, he's done for. But if he plants oranges, bananas, and avocados, there's a good chance at least one crop will thrive. Same principle. So diversification is like creating a financial safety net and giving yourself more chances for growth. Why does diversification matter? Let's talk about risk. Investing always involves some level of risk. That's just the game. But smart investors don't try to eliminate risk, they manage it. And that's where diversification comes in. Here's a quick example. Let's say you put all your money into one tech stock. That company might soar, but it could also tank because of a scandal, regulation, or even just a bad earnings report. Now imagine instead, you spread your money across 20 different companies in various sectors: tech, finance, energy, consumer goods, and healthcare. If one or two companies perform poorly, it won't destroy your entire portfolio. Diversification doesn't guarantee profits, but it does reduce the chances of devastating losses. It's kind of like wearing a seatbelt. You might never need it, but if something goes wrong, you'll be really glad you had it on. The main types of diversification. So, how do you actually diversify? There are a few layers to it. Let's break them down. Diversify across asset classes. Think of asset classes as different investment categories. Stocks, ownership in companies, high risk, high reward. Bonds, lending money to governments or corporations, generally lower risk. Real estate, physical property or REITs, real estate investment trusts. Cash or cash equivalents, like savings or money market funds, safe but low return. Commodities, like gold, oil, or agricultural goods. When you mix these together, you smooth out the ups and downs. Stocks might be flying high while bonds are steady. Real estate might dip, but gold could rise. The mix you choose is called your asset allocation, and it's based on your age, risk tolerance, and goals. Diversify within asset classes. Let's zoom in. Say you're investing in stocks. You don't want all of them to be tech stocks, right? That's not really diverse. So within stocks, you can spread your money across different sectors: tech, healthcare, energy, financials, consumer goods. Different countries: US, Europe, Asia, emerging markets. Different market caps: large cap like Apple, mid cap like Etsy, small cap like some newer startups. Same goes for bonds. You can diversify between government bonds, corporate bonds, short-term versus long-term, high quality versus high yield. The goal is to avoid being too concentrated in one specific area. Geographic diversification. Here's something most people overlook. Your home country is not the whole world. If you're in the US, you might naturally lean toward American companies. That's called home bias. It's comfortable, but it limits your opportunities. Global diversification means investing in international companies too. That could mean stocks from Europe, Asia, or developing countries with growing economies. It helps protect you if your home economy hits a rough patch, and it opens the door to growth in other regions. There are different ways to invest that naturally help with diversification. Mutual funds and ETFs, exchange-traded funds. These are baskets of investments. Instead of picking individual stocks, you buy into a group of them. Example, an S&P 500 ETF gives you exposure to 500 large U.S. companies. International ETFs give you access to markets overseas. Bond funds spread your money across many types of bonds. One share of an ETF can hold dozens, or even hundreds, of companies. That's instant diversification, even with small amounts of money. How to start diversifying, even if you're new. Let's say you're just starting out and don't have a ton of money to invest. What should you do? Start small. Use ETFs or index funds. They give you built-in diversification at a low cost. Look for something like a total market ETF, covers all U.S. stocks, an international ETF to add global exposure, a bond ETF to add stability. If you invest just $100 across those three, you're already more diversified than a lot of people with $10,000. As you grow, you can get more specific and build out your strategy. But the key is, start with balance, not hype. So, here's the bottom line. Diversification isn't about being fancy. It's about being smart. It's not about chasing the hottest stock. It's about building a portfolio that can handle the ups and downs. It's not just about growing your money. It's about protecting it too. By spreading your investments across different assets, sectors, and regions, you give yourself a much better shot at long-term success, without having to constantly guess what the market's going to do next. Because let's be honest, no one really knows what's going to happen tomorrow. But if you diversify wisely, you don't need to. You're covered either way. So whether you're investing $100 or $100,000, make diversification your best friend. It might not be flashy, but it's the foundation that long-term wealth is built on. Thanks for watching. If you found this helpful, don't forget to like and share it with someone who's just starting their investment journey. And remember, investing doesn't have to be overwhelming. Start small, stay consistent, and diversify smart. You've got this. See you in the next one.